It's a big weekend. Trump says he's got a brand new Iran truce. Well, I'll tell you why I'm not really buying it. And then July is now in the books. August is ahead. And the guy who really matters right now, new Fed Chair Kevin Warsh. It's Monday, August 3rd. I'm Charles Brown, your portfolio manager. And this is CB3 Financial's weekly podcast. So what's the deal? Sunday, August 2nd, yesterday, Trump calls off a planned strike and posts that he'll cancel more of them subject to being able to rapidly make a deal. Trump loves the word deal, as you know. He claims the perimeters of a deal are already agreed upon. Well, he wrote perimeters, but he really meant parameters, all right? So that tells you the rigor. Nothing is signed, a pause conditional on a deal that doesn't exist yet. His demand, immediate, complete, and total opening of the Hormuz Strait. What I want to know is, why does he have to ask them for that with the size of the naval military that we have? I just don't get it. But it's this consternation that the market is so tired of because they expect the U.S. to be able to open the strait if they really want to, but that doesn't seem to be the case. So what is Iran's answer? Well, they're threatening a decisive and proportionate response to the U.S. breaking the truce. All right? It's the fourth act of the same play. The April two-week ceasefire collapsed. The June Geneva MOU, the Hormuz reopened 60-day nuclear clock, yeah, that collapsed too. So the U.S. hit 90 targets between July 8 and 9. Strikes were paused on the 26th because, frankly, I think they ran low on munitions, no peace. And then on July 28th, no negotiations with the U.S., says Iran. Are you guys getting the picture here and wondering why the market is so volatile and your accounts, therefore, accordingly, are also so volatile? We had huge moves up and down in July with the S&P finishing up 1%. Just hardly any movement at all. If you looked at that and didn't know what happened intra-month, you'd think it was a boring month, but it was anything but that. But on the ground, Hormuz is still closed. The war is spreading. Drone hits on Egypt now. And Lloyd's of London expanding Red Sea high-risk zones. Lloyd's of London, of course, is the major insurer for high-risk adventures on this planet. So those three choke points are in play. And what that means is Brent oil at $72 is now over 90. That's Brent North Sea crude, which is the European standard to offset by West Texas Intermediate, which is the U.S. standard. So my take, I hope I'm wrong, but I manage money on facts, not press releases. A truce not signed by anybody that Iran mocks over a strait that's still shut is not peace. It's a ceasefire of the week, ceasefire du jour. So that's just my editorial. It's important as a portfolio manager to keep a perspective here. We stay invested. We have downside protection in our aggressive program, DS, which is, of course, the put spreads there. And that helped a lot last month when the chip stocks were just getting massacred. So we did have a down month in that program, but it could have been much, much worse without that downside protection. So you can position this however you want. My caveat is that the real escalation spike oil first, and then a decisive strike in a short-term bullish energy environment is what's going to stop this and maybe finally end this war. But I'm just guessing, folks. I mean, that's just like you. I've been watching all of these stops and starts. So July, really, the big picture held near the record high. So the S&P still up about 10% on the year. But momentum stalled into the month end as oil spiked and the Fed turned hawkish. And again, hawkish is not the word that Donald Trump wants to hear from Kevin Warsh. But what worries me, or not really worries me, but what I'm noticing is the concentration. So 10 stocks and 10 stocks only, 78% of the S&P's year-to-date gains are in NVIDIA, AMD, Micron, Intel, Alphabet. That's a pretty thin foundation, and that's the reason why we basically dropped CG and GI last month and have focused now on MP, which is a market proxy. That's what those initials stand for. And then DS, which is our winning almost 8-year track record now, beating the S&P by 146% over that almost 8-year period. So the August seasonality, pretty weak. Okay, August and September are the weakest months of the year, mostly because market participants are out having vacations wherever they go. September being the only negative average month during the course of a year since 1950, but we'll get there next month. Right now, we're dealing with August. So live risk stacked 90% oil. That's really going to feed inflation. That's not what we want to see. A Fed says it may actually hike in September. And remember, Kevin Warsh was brought in here by Donald Trump to drop rates, not increase them, but he's going to do what he needs to do to keep the Fed's mandate of 2% interest, okay? So our playbook, we rebalance the winners, we keep energy as a ballast, we stay in quality assets, and we hold some dry powder for that August dip. So we're watching Kevin Warsh, okay? That's Powell's replacement. Remember, Powell is still on the Federal Reserve Board of Governors. Crazy. Haven't seen that in decades, all right? Where someone who was the president stayed on there. I guess he likes his power. I don't know. But the Fed on the July 28, 29 meeting held the rate at 3.5 to 3.25, but under the hood of a 9-3 vote. So there were 3 members of the Federal Open Market Committee that said, no, we need to hike. We need to hike. Certainly no one was saying we need to cut rates, all right? So the market hears it. There's a 61% chance of a hike at the September 15-16 meeting. There is no August meeting, and cuts are off the table, I think, for the rest of the year. So why is that the ball game? Well, 15 years of the Fed put, which is the backstop that you hear that Alan Greenspan made famous when the Fed makes policy that basically says we're not going to let the economy go any worse than right here. That's the Fed put, all right? Warsh signals just the opposite. He will hike into an oil shock if he thinks it's necessary, and the Warsh put strike is far lower, even if it exists at all. Even Ben Bernanke was not this aggressive when he was the Fed chairman 2 chairmans ago. All right, Janet Yellen was in between them. So for us as clients and participants in the market, we are careful on long duration bonds, and we don't have any of that exposure right now in MP. And we don't have any of that exposure, of course, at all, any bond exposure at all in DS. But we're favoring high quality cash flow over story stocks. All right, we still are reaching for the stars in DS because that's what's worked so well for us for our almost 8-year track record. So that's the wrap on the report, and here's what we have. We have a paper truce that I don't trust. We have a top-heavy market walking in to its weakest season with August and September, and a Fed that will hike, not rescue. It's not a panic. It's just discipline. It's rebalance. It's an energy ballast, up in quality, and keep dry powder. The next catalyst, the September 15-16 Fed meeting. Warsh hiking into a $90 oil. I don't know that oil will be $90 by the time we get there in mid-September, but we will just have to wait and see if that's what happens based on the outcome of this brand new truce. That's what's going on, folks. I'm Charles Brown, your portfolio manager, reminding you that at CB3 Financial Group, we don't just manage your assets, we become one of them. Have a great week ahead. We will see you and hear you next time.